Okay, episode 3, ranges. Ranges are one of the most, if not the most important concepts regarding technical analysis itself, right? We are always looking to trade a range, okay? Every time we're trading, we're looking to trade a range in some way or form, okay? So this is how important it is. We're either going from sell stops to buy stops, which would be trading a bullish range, or going from buy stops to sell stops, trading a bearish range. Every range has 3 levels to keep an eye on: the range high, the range low, and 50% of the range. What do we focus on, right? Selling the range high when bearish, do not buy the range high. Buying the range low when bullish, do not ever sell the range low, right? Sell high, buy low. 50% of the range as a target and 50% of the range as a continuation if we break through it. Okay, so really important that 50% is also mapped on your chart. How do you identify the range? Now, there's 2 types of ranges you're going to be looking at, and there's only 2: a structural range and 1 candle ranges. So structural ranges, how do you identify them? It's really, really simple. It's the low that's obviously connected to a high, right? It's an expansion leg. Or a high that's obviously connected to a low. Do not overcomplicate it. It really is this simple. You increase range trading probabilities by blending them with a high time frame key level, and this is actually one of the core foundations once we get to the intermediate and higher time frame perspectives. So let's start off with the structural ranges. So looking at this chart, you can see we had a key level here, okay? And like I said, when we have a key level, we want to pair it with a range. Do not overcomplicate it, like I said. This is an expansion leg, right? This high is obviously connected to this low. There's no secret to identifying the range, okay? It's really this simple. This high is connected to this low, right? And then you can see price goes up like that. You don't need to anticipate this beforehand. When price is here, you know, okay, well, we have our key level here. This high is obviously connected to this low. That's your range. That's your structural range. The market then trades down into the key level, right? Hits the key level, takes the range low, okay? Accumulates the stops here, and then attacks the range high. So it's going from sell stops to buy stops, right? The reason this is so effective and this keeps happening is this is one of the fundamentals of how liquidity works, right? The market makers, or whoever runs the algorithm, they're accumulating sell stops below this low. They need to be able to pair these orders with the opposing liquidity. That opposing liquidity is going to be at the range high. They're buying low here, right? Because you've got retail traders selling on a breakout. So they're buying those orders low, and then they're getting out here above the range high, okay? So they're buying down here and they're selling to breakout traders, retail traders who are buying a breakout of the range high, right? So it's really important to understand the ranges because this is how smart money trades, and you want to trade in line with that. Okay, now let's look at an example here on the 15-minute chart. We have a premium to discount, and this is one of my favorite ways to frame a trade. When you have a dealing range, okay, with a range within it, right? So this is a dealing range, okay? And this right here is the range within it. So which low is this high obviously connected to, right? It's obviously connected to this high, right? This high is connected to this low. That's your range. Now, when you pair this within a dealing range, it becomes super high probability. It's trading a range as a continuation from a premium, right? So this right here is our range. 50% of the range, always have that mapped. We go from the range high into a key level. We accumulate the buy stops above the range high. At minimum, we're going to go to 50%. Okay. Then you can see we break through 50%. We come back up above 50%, run out some stops, and then we melt through the range low, right? So range trading within a dealing range, super important, one of the foundations to how I personally trade. We also have 1 candle ranges, right? So when we have a key level, okay, and we're looking at 1 candle, this could be a daily, weekly chart. This can also help you frame a higher time frame bias. This 1 candle, okay, this is the range high, this is the range low. Okay, if we're bullish and we're looking at a range to trade from sell stops. This would be our range low of the one candle. The one candle's high would be our range high. So we want to go from range low to high or range high to low. So now we trade into the key level. We've run out the range high and we have closed within the range highs candle, right? The candle must close within, right? That is signaling to you that it's a turtle soup, right? And when we get to the long-term perspective, this is going to be amplified with the candle closure video. What we then look for is the market to seek, okay, the opposing end of the range. Now, you do not have to wait for this candle to close, okay, and then trade the third candle. You can trade this candle here because we're running out of range high. You would look for a lower time frame change in the state of delivery within here, which will cover how you'll be able to trade that. Okay, so here's an example on NASDAQ. We have a high time frame key level, right, defined by the fair value gap here. Okay, the market trades back down into this fair value gap. We then have this one candle as the range, one candle range low, one candle range high. We go from range low to range high. So we accumulate the stops here, right, sell stops, and we pair them with buy stops. If we close within, you can anticipate the next day to trade through the range high. Okay, this is what it looks like on an hourly chart. 50% of the range is here. Okay, we accumulate the range low. Okay, at a key level, the market then expands on a lower time frame. You could be looking for entries here, right? Using this logic, we then trade through the 50% of the range. Okay, so we've displaced through 50%, which is our signal that price is going to attack the opposing end of the range. Okay, looking at an example here, we have external range liquidity here taken. Then we have this one candle as the range. So we have this one candle's range high taken. Where is the market going to seek? 50% at minimum, and then one candle range low. And also notice the internal range liquidity here, right? So we're not just pattern trading this logic. We go from external, okay, then we have the range we close within. We're seeking internal because the market has a constant ebb and flow, right, from external to internal. So that's how you build a narrative around trading the range. Okay, this is what it looks like on a lower time frame 1 hour chart. We take the range high here, right? Market closes within. CSD here as well. Fair value gap forms. You could go short there, and it respects every PD rate. Now, watch when it gets to 50% here. You see the wicking here, okay? This is not random, okay? This is happening because it is at 50% of the range, and this is why you always want to have 50% of the range mapped on your charts. It then traces back up, premium from this high to this low, sells off from fair value gap. Then we're accumulating around 50% of the range. Now, you guys are going to notice this a lot. There's a tendency where the market is going to accumulate and chop around 50% of the range. And when a market chops at 50% of the range, it is more likely to attack the opposing end of the range with larger volatility. Okay, put that in your notes. So you can see the market starts accumulating here, and then we run up above this high. That's a continuation purge on stops. We then trade lower, premium retracement into a fair value gap right here, and then the market sells off aggressively, very aggressively. Why? There's a few reasons here, specific liquidity reasons here, which we will get into, but also, like I said, to put in your notes, that 50% of the range accumulation is a signal to you that when we're going to attack the opposing end of the range, it's going to be a massive move.